Does IUL allow me to leave behind the death benefit plus the cash value at my death? I'm going to address this question in this episode, and you're going to be, I think, blown away with what I explain here. When somebody asks me that question, it usually is an alert that they've been listening to naysayers. And so I have to give them an explanation. They have a choice. The reason why I like IUL is because it's flexible. So when people ask me this question, I'll say, yes, if that's what you want, but that's not what I usually do. And then they go, well, what do you mean? Okay. So get ready and I'll explain this in detail. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, prepare for a comfortable retirement so they won't outlive their money. And my favorite vehicle, without question, is a properly structured, max-funded, indexed universal life insurance contract. If it's structured correctly and funded properly, it eliminates the dangers of taxes, inflation, and market volatility, which causes most retirees to outlive their money. And you harness the key elements of a prudent investment: liquidity, safety, and predictable rates of return, okay? And so when people begin to check this out, they're usually told, well, ask the agent, does IUL allow me to leave behind the death benefit plus the cash value at my death? Now, this could be from buy term, invest the difference proponents and what have you. Hey, I get it. But when people ask that question, I go, yes or no. It depends on what you want. And they go, oh, well, what are you talking about? Okay. So when people come to me, they primarily have come to me wanting to reposition money, serious cash, into a financial vehicle or instrument that will grow tax-free at a nice high internal rate of return that outpaces inflation, and then allows them to take out income tax-free that will dwarf other income from IRAs, 401ks, money invested in the market, or what have you, especially under the 4% rule, that would last from age maybe 65 to age 120 without running out of money. That's the biggest fear of most retirees, is outliving their money. And then at the end of the day, when they do die, anything left over will transfer tax-free and usually blossom, increase in value. If that's the objective, to have the highest net internal rate of return, without question, I want my cash value in the policy to qualify as part of the original required death benefit under TEFRA and DEFRA tax citations, okay? I want my insurance costs to get cheaper as I get older. Did you hear that? People say, well, I've never seen a life insurance policy that gets cheaper as you get older. Well, why are they thinking that? It's because every year you get older, the cost per thousand of life insurance, the chance of you dying goes up. That's term insurance, okay? And so, yeah, they reason, well, yeah, the insurance is going to go up as you get older, but, you know, if you buy term, invest the difference, hopefully you have enough cash after 30 years that now you can get rid of the insurance and the costs that are going up. You can eliminate those. Okay. Well, E.F. Hutton, who's the brainchild behind the emergence of universal life and then index universal life, they were just saying, why don't we buy term and invest the difference under a tax-free umbrella? And let's give the client the choice. Do you want your cash value added on top of the death benefit when you die? If you do, insurance gets more expensive as you get older. And so if you diversify and rebalance like we do, we've averaged over 11%. Let's just round it down to 11. If that's what you want is your cash value added on top of the death benefit, you use the increasing death benefit. And so if you earned 11, you might net cash on cash, internal rate of return, maybe 8, okay? 3% at the end of the day, retroactive back to day one, is going to cover the cost of the insurance that keeps going up. Now, if your objective is living benefits, if you want to earn 11 and net 10, which is what our clients do, you want the cost of the insurance to get cheaper as you get older. You want the actual amount at risk to go down. And so if that's your objective, then you choose what is called the level death benefit, okay? Now, if your objective is living benefits, and you're older, you start out with the level death benefit because that'll be the cheapest way to go. And I'll explain this in just a moment. If you're younger, if you're like 35 and you're only socking away like $500 a month, you might choose the increasing death benefit that if you happen to die, your cash value is added on top of the death benefit. But you will sooner or later, no later than when you stop paying premiums into that policy, you're going to want to switch to the level death benefit and not have the cash value growth from that day forward added on top of the death benefit. You don't want that. That is going to cut your costs. It's going to make it cheaper if your objective is to earn 11 and net 10. So far, so good. So let's go through this. Once you understand your objective, okay? So let me just quickly review. If you're using this for living benefits to eliminate the dangers of taxes, inflation, and market volatility, a properly structured max-funded IUL is the dream solution because you're converting to tax-free accumulation and access. You're linking your returns to the things that inflate. I don't like inflation any more than anybody, but I outpace inflation by using Index Universal Life. And by using indexing, I get to participate when the market goes up and not lose when the market goes down, okay? The three key elements of a prudent investment are liquidity, the ability to access your money when you need it, safety, not only of the institution, but safety of your principal. And in any year you make money, you want that to become newly protected principal so you don't lose in future years money you made in previous years, okay? Other financial products can't do that. And then I want to earn a predictable rate of return that historically has outpaced inflation. There are some years that our clients get credited 25%, 61%, 158%. But on the average, they will usually, because we have annual reviews and rebalance and we diversify, they earn usually around 11%, a little bit more than that, and they net 10. Cash on cash, net internal rate of return, okay? Which means if you're netting 10, every $1 million you have of cash value should generate a 10% payout, $100,000 a year without depleting your $1 million nest egg. Show me any other vehicle that does that and it's tax-free, okay? So here we go. When people ask that question, I go, okay, what's your objective? If your objective is to maximize what you leave behind when you die, then use the increasing death benefit. Yeah, you just check that box. I want the increasing death benefit. All your cash value in that policy, when you die, will be added on top of the death benefit. You're maximizing what you leave behind. Sounds good, right? People say, well, why wouldn't you always choose that? Because there's a cost to that. The insurance, if you started out, okay, let's say you're a male age 60 and you want to reposition $500,000 under TEFRA and DEFRA tax citations, I can get away with as little as $1 million of life insurance, okay? Now, if I choose the increasing death benefit and I pay $500,000 in there in accordance with TAMRA during the first 4 years and 1 day, I have $500,000 in there. Now, the cash value will be more than that, but let's just keep it simple. That means if I die, the insurance company will pay out $1 million plus $500,000. And so that sounds good, but there's a cost for that, okay? I'm 5 years older, let's say, and so the cost of insurance for $1 million is going to go up because they're going to have to pay out $500,000 on top of the $1 million. So the cost is going up basically because the original $1 million is what I'm paying for, even though $500,000 is my cash value. So if my objective is to have the highest net internal rate of return, the spigot on the bucket, which is the cost of insurance, it's going to stay the cost of $1 million of death benefit the rest of my life, which is going to keep getting more expensive. The spigot's going to get bigger. If I earn 11, I'm only going to maybe net 8. It's going to gobble up 3% of my rate of return, let's say. If I want to earn 11 and net 10, I want that spigot to get smaller as I get older. So the level death benefit is what you choose sooner or later. If you're older, you choose it right off the bat, which means this: I don't care what I leave behind when I die. That's not my objective. When I put in $500,000, if I die, the insurance company is only going to pay out $1 million. People say, oh, your cash value was soaked into the death benefit. That's what I wanted. Why? Because if my $500,000 of cash value qualifies as part of the original death benefit, the insurance company is only at risk for the remaining $500,000. They're only charging me. 4 years and 1 day into this, they're only charging me for half as much risk, $500,000 of death benefit instead of $1 million. It's half as much as they were charging me 4 years earlier. Hello? The spigot is cut in half. It's getting cheaper. Now, many times, I've averaged not only 11, but since 1980, 9.62. Let's use that. 9.6% rate of return divided into the rule of 72. Your money doubles every 7.5 years. This 500,000 in the 11th and a half year of this policy now has grown to $1 million. And people say, well, what happens if you die? Do you get your $1 million of cash value and the $1 million? No, I didn't want that because I didn't do it for that. My $1 million of cash value now is equal to the death benefit. What's the spigot? The cost of insurance is Zippo. Now, technically, if I died, the insurance company pays out $1,050,000, 5% more than that. The point is this: they're only going to charge you for $50,000 of life insurance of risk. The interest you're earning on the $1 million of cash dwarfs the minuscule cost of $50,000, 1/20th of what they were charging you 11 years earlier. Okay? $1 million can generate $100,000 a year tax-free income because of this, because the spigot now, the insurance, you're self-insured. Your cash equals the death benefit. Let's say you don't need the income yet. The $1 million in the 11th year, in another 7.5 years, grows to $2 million. Now you've got $2 million of cash value. If you die, what do they pay out? $2.1 million. They're only charging you for $100,000 of net amount at risk because my cash value now has grown to double the original death benefit. If I was still sitting there wanting an increasing death benefit, the cash value would be on top of there, but my cash value would not be $2 million. It'd be less than that because it wasn't earning a rate of return as high because they were charging me for the original $1 million, and it gets more expensive for 17 years. Every year, it keeps getting more expensive. So the spigot on the bucket is draining out 2 or 3% of my rate of return instead of 1%. Hopefully you're going, oh my heavens, okay? I didn't understand this before. So hopefully in this episode, you have to analyze what's your objective. If your objective is living benefits, if you want the highest net internal rate of return, cash on cash, you choose the level death benefit. If you're older, no question, right off the bat. If you're younger, you can use the increasing death benefit while you're funding it monthly for 20 or 30 years. But as the latest would be when you stop funding it, you switch to the level death benefit so that you'll have the cost of insurance get cheaper as you get older. A lot of people don't understand this. They think, oh, universal life is going to crash and burn. It's going to get too expensive as you get older. Why? When you're actually self-insured, your cash value has far exceeded the death benefit, okay? So here's another thing. I like universal life because it's flexible. What do I mean by that? You can switch back and forth. Just like if you started out with an increasing death benefit at age 35 and you stop paying premiums at age 55, you switch to level death benefit. From that day forward, now any of the cash value is that grows from that day forward is not added on top of the death benefit because you don't care. You want the cost to get cheaper as you get older. Let's reverse that. Let's say you've got the level death benefit, and all of a sudden you're diagnosed with a terminal illness. The doc says you got 12 months to live, and you want to maximize what you leave behind. Switch over to the increasing death benefit. Now, you need to remember, if you switch over, it's a stroke of the pen. you're not going to get all your previous cash value added on top of the original death benefit. But from that day forward, all of the growth on your cash value will be added on top of the death benefit from that day forward. It's very flexible. You could switch back and forth between increasing and level death benefit depending upon life and what happens in your life, okay? But most max-funded IUL, the cash value will grow to equal and exceed the death benefit within the 10th to 20th year of the policy. This is the long-term strategy. So don't get hung up on, oh, wow, your cash value is going to be soaked within the death benefit. I don't care. That's not my objective. I want to have the insurance get cheaper as I get older. This is like buy term and invest the difference on steroids, okay? And again, it's flexible. You can switch back and forth between the two based upon life and your circumstances. The death benefit increases from that day forward if you switch over to increasing death benefit, not retroactive back to the first day. But I love the flexibility of IUL. So hopefully this gave you some insights here. Hopefully you know that if you want to learn more, I've written 12 books. This one is probably it's flying off of a warehouse shelf. You go to laserfund.com and you contribute a nominal amount towards the shipping and handling. I cover the rest of that, and I'll pay for this 300-page book and fire out a hard copy to you, okay? But if you want to do a deeper dive into this, I would recommend that you watch this episode to go a little bit deeper on a different perspective, okay? But this is not about me. This is about you and your brighter future.